Hi, everyone. Welcome back to the Weekend Charts, where I run through the most interesting charts and themes in markets and investing. Another big show for you today. Today's show is brought to you by my friends at Y Charts. Take a look at the show notes to get a link to a free trial to Y Charts and 20% off when you first sign up for the service. Also, I want to mention doing a big webinar with Y Charts on bear markets, recessions, much more next week, June 14th. 1 p.m. Central, 2 p.m. Eastern. So take a look at the show notes. I'll have a link to sign up for that webinar. It's open to everyone, so I hope you can join us for that. I want to start out today by talking about the bounce that we've seen. So in the S&P 500 last video, we talked about the extreme oversold condition where stocks were really primed for a bounce. So the data had shown that when stocks were this oversold, you tend to see above average short-term returns going forward. That's indeed what we've seen. S&P's rallied just a little under 10% from its low on May 20th to its high on June 2nd. This is now the third bounce that we've seen, a sizable bounce that we've seen since the start of the year when the correction began. And let's just take a look at the other two here. So January 24th low, we have a bounce close to 9%, hit a high in February 2nd, back down, hit new lows again. Then we had a second bounce, bigger bounce here, February 24th low a month later, and it would go on to rally almost 13% to its high on March 29th. Market goes down again, hits a lower low. We get the bear market territory here on May 20th. And then since then, we have that oversold rally close to 10%. So what's the question? What's everybody asking? Of course, is this the low? So is this the bottom, or is this just another dead cat bounce where we're going to see lower lows ahead? So I asked that question this week on Twitter. We got over 8,000 responses, so a pretty good sample size. And the results are pretty interesting. Most people seem to believe that it's just a dead cat bounce, and we're going to see lower lows ahead. So pretty bearish type of sentiment here. I think a lot of people are skeptical of the rally for good reason. You're hearing inflation continues to be a problem, fears about a recession. As we talked about, the average decline for a bear market during a recession tends to be much greater than 20%. So I think all of that is front and center on people's minds. And so much more people are skeptical that this is the actual low and they feel like there's a lower low ahead. So we'll see what happens. Interesting results. Of course, anything is possible, even if it is a recession, as we talked about. It could be the low because in 1990, we saw a recession, only 20% decline, and then stocks bottom. So every bear market's different. While the odds suggest if there is a recession, there's more pain to come, anything can happen in markets. Next thing I want to talk about is kind of the unusual state we're in this year, which is stocks and bonds going down together. So typically, when you see big stock market declines, you tend to see bonds kind of cushioning that blow. And so the last 8 years, we've seen stocks decline. We've seen positive returns for bonds. And what's going on there? Well, when stocks are going down, you tend to see people worried about the economy. And when they're worried about the economy, they tend to be worried about demand and growth, and interest rates tend to fall during those periods of time. And when interest rates fall, bond prices rise. This year, it's very different in that the source of the pain for the equity market, for the stock market, is a concern about rising interest rates and rising inflation. So, of course, that's not good for bonds. Interest rates rising, bond prices fall. So how bad is it if we look at a 60-40 portfolio? Well, through May, a 60-40 of the S&P 500 and the Barclays Ag Bond Index is down over 11%. That's by far the worst start to a year we've seen in history. Now, there's still plenty of time left in the year. The markets can do anything from here. But again, very different picture than we've seen in recent years. If you had a diversified portfolio of stocks and bonds, this is the worst kind of pain you've seen in quite some time. You really have to go back to 2008. And that was really dominated by the stock side going down, because as we talked about, bonds were actually up that year. So what's going on in terms of earnings? We're pretty much at the end of first quarter earnings seasons. 97% of companies have now reported. And what we're seeing thus far is the first pullback that we've seen in terms of earnings. So if we compare first quarter earnings this year to Q4 of last year, we're seeing a 15% decline in S&P 500 earnings. And if we look year over year now, we're close to flat in terms of the growth rate. So again, we had the big move down when the pandemic first hit. Corporate earnings went down, then they recovered, hit new all-time highs starting in Q1 2021, continued throughout the rest of that year. And now we're seeing a leveling off in terms of the growth rate and actually a pullback versus the fourth quarter of last year. And what's going on? What's driving that pullback? Well, it's really on the margin side. So companies are starting, if we, as we talked about last time with Walmart and Target and their warnings, companies are finding it harder to pass on those higher costs to consumers. And so a direct result of that is that margins are compressing. So margins hit an all-time high in 2021, 13.5% profit margins. Now they're down to 12%. And so, which is still very high in a historical basis, but that it's that movement, it's that trajectory that people are worried about. If that were to continue, well, now you have additional pressure on corporate profits and earnings, and just another story for investors to be worried about. So let's talk about the housing market. And this is a frequent topic, of course, because we've seen just such extreme moves, and month after month, we get more and more data on that front. And now we have the Case-Shiller National Home Price Index hitting another new high, up a record high for the 38th month in a row. So it's an incredible run higher, and really most of those gains, the big outsized gains, have been just in the past year or two. And so if we look at the year-over-year rate of change in this index, up 20.6% over the last year, that's the highest on record with data going back to the 1980s. So just an extreme move higher. And this is a national picture, but if we dig in and look at the 20 city Shiller Index, we're seeing across the board huge price increases. So every city in the index is up over 10% in the last year, and they're all at all-time highs. And that might seem typical, but it's not. It's very unusual to see everything moving kind of in unison. The last time we saw that was during the last housing bubble in 2005. We saw all the cities at one time hitting an all-time high. So we have some enormous moves. If we look at Tampa or Phoenix and Miami, Dallas, up over 30%. So you have a lot of factors driving that. There's some migration out of certain cities and different areas into obviously Florida, Texas, Arizona have been the beneficiaries, and you see outflows of places like New York and Chicago. But a bigger picture is just the rising tide in housing has lifted all boats, really. And why are we calling it housing bubble 2.0? Some might take issue with that and not call it a bubble. Well, if we look at the relation of housing prices to inflation, I think it tells an important story. Throughout most of history, housing prices have closely tracked the overall rate of inflation, which makes sense. The cost of a house at the end of the day should be a function of the materials costs and labor costs, and it should also be a function of incomes, and that tends to track the overall rate of inflation over time. We've seen two big deviations from this on the upside. One was during the first housing bubble, where we almost got to 100% above the rate of inflation. Then we had the correction after that, and now we've seen it rise to new heights. So this is the highest level we've seen of home prices relative to inflation, which is just overall US CPI. So very extended. We have a number of factors suggesting there's going to be a slowdown in the housing market to come. Looking at home sales, I think this is a big, tells an important story. We've talked about affordability and how it's plummeting due to rising mortgage rates and record high prices. And so the first thing you tend to see during a housing correction is a slowdown in transactions. And so we're seeing this here in new home sales, lowest since April 2020. And just recently, we got data on the commercial side of things suggesting there's a slowdown there as well. The year-over-year rate of change on commercial properties transactions is now down year-over-year after 13 straight months of increases. So rising interest rates coupled by lower affordability is starting to finally put pressure on the housing market. and we'll see how much that deepens in the months to come. So let's talk about the gas pump. This is obviously something everyone's talking about because the moves keep getting more and more extreme every single day. For the past month, basically, we've seen a new high in prices of gasoline. If we look at the big picture here, we're almost at $5 a gallon nationally in the US. This is a national average. If you look at places like California, you're well above $6 a gallon. So there's some dispersion within that, but pretty much everywhere, prices at the pump are going up. This is now significantly higher than the peak we saw back in 2008, $4.17 a gallon. And what this is doing to consumer sentiment, it's just a daily reminder to consumers that inflation remains a big issue. So what's that doing to consumer sentiment? It's really driving it much lower. If we look at who this is hurting, well, if we take inflation and we look at things like food and gas and necessary items that you really need to get to work, obviously you need to feed your family. It hurts the lower income groups disproportionately much higher, obviously. So as a percentage of your income, if you're making less than 50,000, it's going to be a much higher percentage of your income that you're spending on gas prices than if you're making, in this case, chart here showing more than 125,000. So big difference. Inflation is really the biggest tax on the poor because they have lower incomes, and just as a percentage of that income, it's going to be a higher percentage mathematically. And also, they tend to hold less assets, so they're not benefiting necessarily from that rise in home prices if they're renting. And we're seeing rents continue to go up 15% over the last year, hitting new highs again in May. So if we're looking at sentiment, we look at polls, and another interesting one came out last week. Wall Street Journal put this out. And this is a poll that goes back to 1972. So pretty long data set. And the number that came out, 35% that were not satisfied with their financial condition, was the highest we've ever seen in the history of this poll. So obviously a lot going on driving that, but the big factor, if you ask people, it's inflation, and it's inflation outpacing wage gains, as we've talked about for now 13 consecutive months. So you're feeling poorer because prices are going up more than your wages, and that's leading to a sentiment picture that's pretty extreme in terms of people are not very happy about their current financial condition because they're seeing prices outpace wages. So the question then, of course, is how is consumer spending holding up? If we looked at things like retail sales, how are they still so strong if the consumer is so negative? And you have prices outpacing wages? Isn't that going to lead to a slowdown in demand? We haven't seen it just yet. If we look at inflation adjusted retail sales, they're still very, very strong. And there's really two factors driving that at the current time. And number one, it's the savings rate. So following the initial stages of the pandemic, you had the 3 stimulus bills that boosted savings rates to their highest levels ever. But after that third stimulus check in early 2021 came out, we've gradually seen just a decline in the savings rate. And now we're in the period where, again, prices are outpacing incomes, and consumers have a choice. They could either spend less or they save less and maintain their level of spending. And thus far, they've chosen to save less. And we now have a savings rate of 4.4%, which is the lowest we've seen since September 2008. So big factor there, consumers saving less in order to maintain their spending habits. Number two, they're borrowing more. So if this is a chart showing consumer credit year-over-year rate of change, 7.5% increase. That's the highest we've seen since back in 2011. So the question for the economy, is the consumer going to continue to do these things to maintain their level of spending? What would drive the economy for sure into recession is if the consumer says, no, I'm not going to take from my savings, or I'm not going to borrow money to finance these purchases. I'm going to pull back. And we've seen some evidence of a start to that. And we've heard from Walmart and Target and other retailers saying they're starting to see decline in discretionary item spending, but we haven't seen a huge decline just yet in those factors. So this is going to be something that we're watching very closely. Hopefully, it resolves itself with the inflation rate coming down and wages maintaining, and resolves itself that way. But the consumer, of course, still has some savings built up from those stimulus bills. The question is whether they're going to want to draw that down and use that to maintain their level of spending. And that's very much a psychological question at the end of the day. And it comes down to many factors, but how comfortable are they about their financial position where they want to continue spending at the current rate, right? Certain things you don't have a choice, obviously, food, gas prices, if you have to drive to work. But other items, of course, particularly travel, entertainment, discretionary electronics, things like that. Well, now you have more of a tougher decision to make. Do you want to continue to buy those things or hold off? And thus far, we haven't seen a big decline, but I think the expectation for a lot of people is that we're going to see that. And so we'll watch this data very closely and see what happens. And let's talk about the bear market and what's different about the current bear market than we've seen in a long, long time. So as you know, the S&P recently, back in May, is down 20%, and it's not the first time we've seen that. We see bear markets all the time. Going back in history, what's different about this bear market than any of the ones we've seen in recent history is what the Fed is doing. And so this is just a look back and starting with the 1987 stock market crash and bear market, what the Fed's response has been to each of those bear markets. So back in 1987, Fed cuts interest rates and in response to the stock market decline. 1990, there was a bear market, also a recession. Fed cuts interest rates from 8% down to 3%. 1998, in the middle of the dot-com bubble, there was a 20% bear market. The Fed provided liquidity, cut interest rates there as well. Then you had the long bear market from 2000 to 2002. Fed starts out at 6.5%, cuts rates all the way down to 1%. Then the financial crisis, 2007 and 2009, the Fed cuts rates from 5.25% down to 0. 2011, you had a little bear market around 20%. At the time, people were expecting the Fed to hike rates off of 0. They say explicitly at the time, we're not going to do that. We're going to keep rates at 0%. And they start this Operation Twist. This is kind of shifting their purchases of bonds. And then they end up in 2012, starting QE3. Back in 2018, the Fed was hiking rates at the start of that bear market. But then as soon as the December rate hike hit and we got to that 20% level, the Fed did an about face. They actually started cutting interest rates in 2019 from 2.25% down to 1.5%, and they started QE4 back in 2019. But they said, we don't want you to call it QE, but they were essentially buying bonds and adding them to their balance sheet, which is kind of the definition of QE. Then in 2020, you have the bear market. Of course, the Fed immediately cuts rates from 1.5% down to 0. And they start the biggest expansion in their balance sheet in history, QE5. And that brings us to today. So what's going on today? Very different picture. We have the Fed, of course, hiking rates now a few times with the expectation that they're going to continue to do so. And we're already at that 20% bear market level. The market is still expecting the Fed to bring the Fed funds rate up to 2.75% to 3% by year end. With 50 basis point hikes in June, July, September. So still an aggressive policy. And at the same time, the Fed has started unwinding their balance sheet. So their balance sheets start seeing decreases starting in June. And those decreases are set to accelerate as we go on in the year. So very different picture here, very, very different template. We haven't seen the Fed tighten monetary policy in a bear market since the early 1980s under Paul Volcker. And similar to today, the bigger fear back then was inflation. And so that's what's really driving it. The Fed wants to be easy. Their base case default policy is to provide easy money. And we're now in a very different situation where they have to be worried about inflation because it's just staring them in the face. And as we talked about with the sentiment polls and the public opinion, it's really shifted where that's the main concern of most people in America. They want inflation to be brought under control, and the Fed can't keep interest rates as low as they've been and retain credibility. So, very different expectation, which should tell you that in relation to these prior bear markets, you can find some parallels, but this is very different than a bear market we've seen in a long time, because for now, at least, the Fed is operating on a different playbook where they're not easing policy, but they're actually tightening policy into a bear market. And to be clear, the Fed is not alone. If we look at a global chart of central banks, we're seeing almost at least three quarters of the banks, central banks out there, hiking interest rates, with the remainder of them expected to start hiking in the months to come. So even the holdouts like the ECB, who still has negative interest rates with an 8.8% inflation rate, they're now expected to finally start hiking rates in July. So we just have many countries behind the curve where that inflation rate is higher than the central bank rate. The U.S. Is really stands out as well at negative 7% in terms of the real Fed funds rate. So more hikes have to come, and this hasn't been the situation for at least developed market central banks in a long time. So we've seen it in emerging markets. This was thought to be only a problem in emerging markets where they have inflation, and it's a problem there as well. If we look at Brazil and obviously Turkey, Argentina, and the like, there's very high inflation rates there, and we've seen different policy responses there. But now it's a factor for pretty much the entire world. And so places like the Eurozone, where they haven't had to do anything for quite some time, they've had negative interest rates since 2014. They're now forced to really rethink that policy. That hasn't really been effective. And what are you going to do about these high rates of inflation? And so, as we talked about, the Fed is still behind the curve. They're expected to get closer to that inflation rate. And hopefully we get to a more neutral Fed funds rate by the inflation rate coming down as well. So very different scenario than we've seen. I want to end with a positive note, as we like to do. The jobs market, we got another good data point on jobs report with non-farm payrolls hitting their highest level since early on in the pandemic. We've now recovered 21 million out of the 22 million jobs that were lost in just 2 months in March and April of 2020. And we're really on pace to hit, as long as we don't go into a recession where there's job cuts, broadly speaking, we're on pace to hit new highs in this non-farm payroll index this year. So hopefully we get to that point. If we look at the unemployment rate, it stayed steady at 3.6%, which is obviously well below the historical average, only 0.1% above where we were just before the pandemic, and that was a 50-year low at the time. So good news in what's been still a difficult year for markets, for the economy. Really the bright spot has been the labor market. And if you look across a number of businesses, there still seems to be a shortage. There still seems to be hiring demand. If you look at job openings, they're still very high, and the spread between job openings and the number of unemployed people is still very high. So if you're looking for a job in certain areas, it should still be easy to come by. We're, of course, hearing about layoffs in the tech sector and businesses that really expanded too quickly due to the big increases we saw in terms of technology demand and sales. So hopefully that's limited to that sector and that doesn't continue. So this is really a bright spot. And this is the question of whether the U.S. Will go into recession. And some of it will hinge on the labor market and employment, because you typically have a decline in jobs during recessions, and we're not seeing it just yet. So there's still some demand out there in terms of sales, as we talked about. That's a bright spot, and there's still a pretty strong labor market overall. If those things were to turn, then you have what's currently a slowdown turning into a full-fledged recession. But we'll talk more about that next week. Thank everyone for joining me. Have a great rest of the week. And again, take a look at the show notes to join me for a longer webinar on a lot of interesting topics with Y chart. So take a look for that link. Take care.